Welcome, everyone. This is our last webinar pertaining to our high net worth series. So I appreciate everyone taking the time over the last 4 months to join us. We have an A team. We have our A team together for our last presentation of the year. We have Ron Heck from our White Plains office, Mary Delman from our New York City office, and PJ Manchada from our New York City office. So, we're going to focus on some of the tax planning ideas and what's been going on in the legislation for 21 and what people can expect for 22. Sorry, I just left the camera up for a second. So before we get started, we're going to have 3 polling questions. If you answer all 3 of the polling questions, you're going to qualify for CPE. Everyone's in listening mode only. But please, if you have any questions, please put them in the chat and we will try to get to them as soon as possible. So without further ado, I'm going to hand it over to Ron Heck.
Thank you, Pat. When I was first asked could I spend earlier in the year, could I spend 15 minutes talking about new legislation? I thought that wouldn't be enough time to even scratch the surface. But it turns out there's been very little in actual legislation. We'll spend a few minutes momentarily talking about little things that changed. Next slide, please. We'll talk about the 3 pieces of legislation that had some minor tax items in it, and then talk about what's on the front burner, the back burner, maybe not on the burner at all, the Build Back Better bill. Next slide, please.
Ron, can you say that 4 times in a row?
No, not a chance. Even with all the caffeine that's in me, not a chance.
All right.
The Consolidated Appropriations Act, which actually was signed in late December of 2020, does a number of things. I'll go through them quickly. The employer credit for paid sick and family leave, which the CARES Act enacted, was supposed to expire at the end of 2020, got pushed to the end of first quarter of 21. The employee retention credit became a red rubber ball. As you'll see as I go through these slides, it was originally intended to expire December 30, 21, got moved to June 30, 2021. The next couple of items dealt with the IRS and Congress battling with each other on the deductibility of the PPP loan related expenses and the timing for the forgiveness of tax exempt income between the Appropriations Act and a recent revenue procedure. That's all been resolved in that all the expenses are deductible. And if you have PPP forgiveness, you really get an option effectively to record your tax exempt income, which will give you basis. Really either in 2020 or in 2021, because your options are recording the forgiveness when you incur the expenses or when you apply for forgiveness or when you receive forgiveness. The 100% cash charitable contribution limit, which originally by legislation was going to go through 2020, got pushed out for another year through 2021. So people that are looking to do significant charitable giving, if they're doing it in cash, they can do it through the end of this year without any concern about adjusted gross income limitations. And lastly, business meal deduction. It's for meals provided at a restaurant during 2021 or 2022. The 50% deduction was temporarily increased to 100%. Next slide, please. The American Rescue Plan Act of 2021 provided a 3rd round of stimulus. This becomes relevant for people that have gotten that 3rd round because that's going to be treated as a refundable tax credit on individuals' 2021 income tax returns, which is going to require making sure people remember whether or not they got it and determining whether, in fact, if they got a reduced amount, they may be entitled to a greater credit. Paid family sick leave got extended to September 30, and the amounts that were eligible for those credits were increased. And the employee retention credit got extended, at least temporarily, to December 31, 2021. And we go to the next slide, and we get to the Infrastructure Investment and Jobs Act of 2021, which was a bill that was passed and signed into law in November of this year. It retroactively pulled back the employee retention credit to no more than wages paid through the end of September 30, 2021. And this was signed in November of 2021. An issue that a week ago we didn't know the answer to. And earlier this week, the IRS came out with a taxpayer-friendly and logical notice that indicated for businesses that were reducing their payroll tax deposits based on the assumption that these large employee retention credits were going to be available. Now that the period of October 1 to October 31 is no longer eligible for the credit retroactively, the IRS has given employers until December 31 of this year to make deposits for those payroll taxes that they thought they didn't have to avoid being subject to under deposit penalties. The other thing that was included in this act was something that will begin actually in early 2024, is that cryptocurrency reporting, and there are definitions about what is a cryptocurrency broker, but cryptocurrency brokers are going to be required to report purchases and sales of cryptocurrency in a fashion very similar to what stockbrokers are required to report now. So that the government will have some ability to monitor what they believe, what Congress believes is hundreds of millions of dollars of unreported income.
And Ron, with that, do you know if the wash sale rules are going to apply?
And wash sale rules will be extended to that as well. Yes, they will be.
Thank you.
Interestingly, that's all that has been in legislation. But if we go to the next slide, I'm going to spend the next couple of minutes that I've got talking about some of the things that's in the Build Back Better bill that the House passed probably about 10 days ago and passed to the Senate for their consideration. And a brief bit of history on this. We had what at that point was presidential candidate Biden's tax proposals. And then after his inauguration in March, there was his tax plan, which had some major and draconian changes. It was revised again in September with lots of tax increases across the board and draconian estate gift tax changes. And what got passed by the House that I'll talk about now for a few minutes was a much watered down version of some of the things that were proposed. And I'm going to preface this with, this is not law. This is a proposal. It's sitting with the Senate. Based on what we're all hearing, the Senate looks like it's going to be making changes and passing it back to the House. So there's no definitive answer whether this will come or not, but just so we know what may be coming down the pike, The individual tax increases ended up being limited in this proposal to a 5% tax surcharge for individuals with modified adjusted gross income over $10 million and an additional 3% surcharge for a total of 8% on those with modified adjusted gross income in excess of $25 million. What's interesting, and Mary will be talking about this a little when she talks about estate and trust planning, is that this $10 million and $25 million threshold for the individual surcharge is a $200,000 and $500,000 search base for fiduciary returns, a world of difference and a potential world of opportunity. The net investment income tax would be expanded to some extent to apply to, and it's horrible that the term high income taxpayer is used throughout this bill for different things with different definitions. For purposes of the net investment income tax, if a married filing joint couple has more than $500,000 of income, all their investment income gains and business income will be subject to the net investment income tax. The real target of this is that S-corp shareholders that have never been subject to self-employment tax of any sort on distributions as S-corp shareholders will, if they are in this high income taxpayer group, will have their S-corp income subject to the net investment income tax, as will active owners of trades or businesses that sell their investments in the business or that the business sells their business assets that under current law would not be subject to the net investment income tax, now would be. Excess business loss limitations, which was a provision that came in with the Tax Cuts and Jobs Act, effective 1/1/2018, and of course was suspended for 2 years because of the CARES Act. The provision provided and will provide going forward that an individual's business losses are limited on their individual return to no more than $500,000 a year. The original legislation said that if you had more than $500,000 of losses and the excess carried over to future years, the excess became a net operating loss, meaning it could be used in full against all kinds of income in future years. Under the BBB bill, an excess business loss in the first year, if there is a carryover to the second year, it will remain an excess business loss, meaning numerically, if I have a $1.5 million excess business loss in a business loss in 2022, I'm going to get a $500,000 deduction in 22, a $500,000 deduction in 23, and a $500,000 deduction in 24. So this is an extension of those losses, not a disallowance of those losses. The only taxpayer positive in this bill is the state and local tax limitation, which currently is $10,000 a year, would be increased under this bill to $80,000 a year. But the reason we also saw alternative minimum tax kind of disappear in 2018 was because the state and local tax deduction was always the single largest item of tax preference that created AMT. So for many taxpayers, if this becomes law, it could end up being a deduction that may not be worth a lot because of alternative minimum tax coming back. Next slide, just quickly on that. was the Build Back Better retirement plan proposals, which is after mega retirement plans. It would prohibit, and these wouldn't be effective until 2029. So there's 8 more years for, if this becomes law, to be changed 12 more times. It would prohibit individuals that have retirement benefits accumulated in excess of $10 million from making any additional contributions to their plans. And for those that are in required minimum distribution mode, starting in 2029, if the value of their plans exceeds $10 million, their computed retirement, their computed minimum distribution deduction would be increased by 50% of the value of their plans in excess of $10 million. So yes, a $20 million plan would require a $10 million minimum distribution. Next slide. Business proposals, limited in what they will do. For C corporations that have adjusted financial statement income in excess of $1 billion over the past 3 years, there'd be a 15% alternative minimum tax. Business interest expense limitations aren't changing, other than that the information would be passed through to individuals to compute their own limitations, rather than partnerships and S corps computing their own. And to take 1 more minute just to talk about a lesson in a tax court case that was issued about 10 days ago. And the name of the case was McNulty versus the Commissioner. And there are 2 lessons in here. The case involved an individual that had a self-directed individual retirement account, and they read online, Google being, a great tax research tool, that somebody was advertising that you could buy gold and put it in your IRA, and you could keep the physical gold in your home, but it still was good for your individual retirement account. They ended up in tax court. Short version of the court's opinion was, not only was this violation of the law that says if you are going to have collectible assets in your IRA, they must be held by a custodian, so that the $300,000 tax that's due on this gold that the individual was holding was due because it was treated as a distribution. But the lesson here was the court said, getting an answer to a tax question of this magnitude by researching it online is not a reasonable way to do it. And they upheld the imposition of the penalties associated with the $300,000 tax liability. The lesson there is, don't rely on the internet, but use your tax advisors for good tax advice. And next slide, please, which should be our next polling question. Would you expect more or less tax legislation in 2022? A, more, B, less, C, not sure, or D, I don't care.
Hey, Ryan, can you also put up polling question number 1? I think we also jumped by that. So if you could put up polling question number 1.
Yeah, will do. I'll just give this a couple seconds, then show the results, and then I'll launch the the first one immediately after.
Thank you. Ron, nice job with recap.
Thank you.
Not much has changed from September, where everyone was scrambling.
Everybody was scrambling and panicking, and it all became, to borrow a line that I used a week ago, much ado about nothing.
Right.
So people are expecting more, not less, which is what I would expect as well. And I guess now we need polling question 1 so that we can catch up. Are you interested in receiving CPE? Yes, no. Good. We got a lot of people on December 8th that still need CPE in the next 22 days.
Yes.
At this point, I guess I will turn it directly over to Mary Delman.
Yes.
Thank you, Ron. So as Pat mentioned, there was a lot of scrambling going on, especially with the state and gift tax planning a few months ago. And then the Buildback Better bill came in, and then a lot of the provisions that were in the prior proposed legislation were gone, as Ron mentioned. So now we're almost back to where we started. So I'm going to give you an estate planning update, talk about what still works, what you can do by year end and into 2022, and mention the new proposed legislation under the Buildback Better bill where appropriate, where it has an impact. So first, I'm going to talk about grantor trust versus non-grantor trust and the benefits of both. Grantor trusts are still good. There's no current proposed legislation that will have a negative impact on grantor trusts. Now, grantor trusts take advantage of the disconnect between the income tax and the gift tax rules. So for income tax, from an income tax perspective, the grantor is considered the owner of the trust. So what does this mean? This means that the income that the trust earns gets reported on the grantor's 1040. But for estate and gift tax purposes, the transfer to the grantor trust is a completed gift and it's out of the estate. So some may think, well, I'm paying the income tax, is that so great? But yes, it is, because it does not deplete the trust assets. You're preserving those trust assets. And by the grantor paying the income tax, they're still moving additional assets out of their estate without having a gift tax consequence. So it does work well. If you have a sale to a grantor trust, it's disregarded for income tax purposes. So there's no gain recognition if you have that sale. And we often see in a grantor trust the power to substitute assets. And the reason I wanted to mention this is because if someone's not sure what to put in the trust, or maybe they don't want to part with that asset, or they're not sure down the road, they may want it back. If you have the power to substitute assets, that means that you put something in the trust and you can always swap that asset out for something of equal value. So if you want to take something back, you can put something else in. So, you know, it works well with grantor trusts. You can also—
Mary, do you see most of the attorneys now putting that power in the trust documents?
Yes, I've always seen it. I mean, it's always been a very common provision, but I'm seeing it highlighted more and more, where it's become a discussion point, you know, with clients. You know, with such a high exemption, people are often a little hesitant to part with their assets. So this gives you at least a way to, you know, swap something out if you want that asset back. You can also turn off your grantor trust provision. So if down the road, the grantor decides that they no longer want to pay the tax on the income, there's usually generally a provision, there should be a provision in the trust that allows you to turn off that grantor trust power, which then makes it a non-grantor trust. Next slide, please. Okay, so non-grantor trusts. Also an effective way to transfer assets out of an estate, but a non-grantor trust is a separate taxpayer, which means the grantor is not the owner for income tax or gift tax purposes. So the trust is paying the tax on its own. It's using trust assets to pay the tax. A non-grantor trust is good for asset protection because you can put limits and restrictions on distributions to beneficiaries, so that can shield assets from your creditors. And with a non-grantor trust, because it is a separate taxpayer for income tax purposes, there may be deductions you can take that are not permitted for individuals or grantor trusts. For example, if you have attorney fees or accounting fees, those are permitted as a deduction on a non-grantor trust return. But if you have a grantor trust and you're passing that income out to the grantor, those deductions are not permitted. So this could be a way to lower the tax that has to be paid. Also, if you have a distribution from a non-grantor trust, that carries out the income to the beneficiaries. Beneficiary may be in a lower tax bracket, so with proper planning, you might be able to reduce the tax that's being paid on the income earned by the trust. Non-grantor trusts are also good planning for the $10,000 SALT limitation. Because they are a separate taxpayer, they get their own $10,000 deduction. If you have a grantor trust, there's only one deduction allowed between the trust and the grantor. But if you have a non-grantor trust, the non-grantor trust gets its own deduction and the grantor gets their deduction on their 1040. So that's a little bit of a benefit to having a non-grantor trust. Next slide, please. So here's the bad news or the challenging news. I'll go with that. So Ron touched on this about the newest tax proposal in the Buildback Better bill. There is this income surcharge, and it is the threshold for trusts and estates is significantly lower than that for individuals. So we have a 5% tax on income above 200,000 and an additional 3% tax on income above 500,000. And if you know, knowing the returns we do here at Citron, it's very easy to hit these thresholds. So what is income for purposes of this surcharge? So income is your modified AGI. And for trusts and estates, it's determined similar to how you would determine that for an individual. But for trusts and estates, you get to take certain deductions when doing that computation. You get to deduct your administrative expenses, so your attorney fees and accounting fees. You also get to deduct the income distribution deduction. So if you made a distribution to the beneficiary and you're carrying out the income to the beneficiary, you get to take a deduction for that. You also get to take a deduction for the exemption. It's small. Trusts could be $100 or $300 exemption and estates are $600, but it's something. So that's how you determine income. So this allows for a planning opportunity because you can take that deduction for your income. You can take a deduction for the income that's distributed to your beneficiaries. So if you have a non-grantor trust and this newest tax proposal goes into effect, you can plan that if you have income above these thresholds, you can pass it out to your beneficiaries if permitted under the trust agreement. And that will lower your modified AGI and it may take you out of this additional surcharge. And by passing the income out to the beneficiaries, once again, they may be in a lower tax bracket. And also, since there's a higher threshold for individuals, there's that 10 million, 25 million threshold, that income may not be subject to this tax surcharge at all. So, you know, it's just a matter of planning and staying on top of what you have in place should these rules be passed. Next slide, please. Okay, valuation discounts. So these were a target of prior tax proposals, but no longer, they're still good. So I recommend taking advantage of valuation discounts when making gifts. If you have an asset that you're giving, maybe it's an interest in a partnership, and you could take a discount for lack of marketability, minority interest. It could be anywhere from 15 to 25% for both of those categories. Then that's a good option for gifting because you're reducing the value of that gift and you're passing all of that future appreciation out to the beneficiaries. One thing I do want to mention is that we need an independent qualified appraisal to value that asset, to show the discounts and how those discounts are determined. This is the best way to ensure that we have adequate disclosure when filing a gift tax return and that the statute of limitations will not run. If we do not have a qualified appraisal, The IRS could challenge the value, and it may not happen now. It may happen when the taxpayer passes away and we're doing the estate tax return. The IRS comes back and says, we're gonna look at your gift tax returns and we don't agree with that value. I mean, I've seen many attempts to cut corners, but I always tell clients and recommend we need a qualified appraisal to fully support that value. Next slide, please. Intrafamily loans. So intrafamily loans, these are loans between family members, take advantage of lower interest rates. You should be, when putting these loans in place, you should be charging at a minimum the published AFR by the IRS. You could go higher if you like, but it needs to be that minimum. Having an intrafamily loan could provide an income stream to, let's say, the parent who's making the loan to a child. You can use an intrafamily loan to fund a mortgage for a child or a grandchild. And by doing that yourself, you could be providing a lower interest rate because the AFRs are still generally lower than what a bank might charge. And you're also avoiding those upfront charges like closing costs. So it could be a more beneficial way to make a loan for a mortgage. It can help a child start a business. And you also have flexibility with the repayment structure. So you could set up the loan so that there are interest-only payments and then one balloon payment at the end of the loan. So there's a lot of flexibility when you're doing it on your own versus going to, a bank or somewhere else. It's also a good way to shift wealth, because if the younger generation can earn a better return on the amount being borrowed, meaning a return higher than the AFR, if that's the interest rate you're going to use, then they basically keep that return, this higher return, free of estate and gift tax. There's no additional charge for that return. So it is also a good way to shift wealth. And please make sure that you have a promissory note in place and the interest rate is at least equal to or greater than the published AFR. Because if it is not, then the IRS could impute interest. It'll take the difference between what the published rate is and the rate you charged, and there could be an interest pickup there and possibly an additional gift. And speaking of gifts, if down the road, once you have this loan in place, you decide that you'd like to forgive the loan, you can do so. You can forgive up to the annual exclusion amount each year on the loan, or you can forgive the loan in full and use your lifetime exemption amount. So there are some options, flexibility. If you're not sure you want to make the gift right away, make it a loan, and down the line, you can take advantage of using your gift tax exemption. Okay, annual exclusion gifts. These are very, very basic gifts. One of the easiest ways to make a gift. There's a $15,000 per donee annual exclusion, meaning you can give anyone $15,000 and not be subject to gift tax. And it starts over every year. So I could give Pat $15,000 now, and January 1, give him another $15,000, and I'm good to go. Pat, don't hold me to that. It's increasing to $16,000 in 2022. So we haven't seen an increase in a while because it increases in $1,000 increments for inflation. So we're seeing an increase. So if you're going to split gifts, meaning you're considering them being made one half by each spouse, you could go up to $30,000 this year and $32,000 starting in 2022. You could use your annual exclusion by making outright cash gifts. You could front load a 529 plan. Basically what you're doing is you're putting in 5 years worth of annual exclusion amount. So let's say if you did it this year, you're putting in $75,000 and you're making an election to treat that gift as being made ratably over a 5-year period. So now you've covered your annual exclusions for the next 5 years, so you don't have to worry about it until then. If you have a trust that has current withdrawal powers, you could utilize those current withdrawal powers, which will allow for the annual exclusion as well. I just want to mention that if you're making direct payments for tuition to a university or institution, as well as medical payments directly to a doctor and institution, these are not considered taxable gifts. They do not use your annual exclusion. They do not use your lifetime exemption.
Hey, Mary, when you were talking about
Yes.
Loans, someone was asking a question. Do you see loans to grant the trusts a lot?
Yeah, I do see some. Yeah.
Okay, that's what.
Yeah.
So we're just inquiring about that.
I see them to non-grantor trusts as well,
Okay.
so. Okay, next slide, because I know I'm running out of time here, so I want to move a little quickly. Federal exemption. So under the newest tax legislation, it's still alive, our $11.7 million exemption, which is increasing to a little over 12 million in 2022. Now it's still scheduled to decrease to $5 million on January 1 of 2026. Index for inflation, it will probably be about 6 million, 6.1 million, somewhere around there. So still consider using this exemption, making taxable gifts. That means above your annual exclusion, your $15,000, if you have that available. In order to take advantage of that additional 5 million, so it started at 5 million, it was increased to 10 million. It's now 11.7 because of inflation. But in order to take advantage of that additional 5 million, you really need to get over that $6 million hump so that you're taking advantage of it, because you use it from the bottom up, not the top down, if that makes sense. So if the exemption goes back to 5 million and you've used 2 million already, you're only going to have 3 million left. It's not that you've used it from that additional $5 million piece. You're starting from the bottom up. So if you're going to really take advantage of this exemption, you need to get over that $6 million number. SLATs are still a good option. These are spousal lifetime access trusts. And these are grantor trusts that move assets out of an estate, but still give access to the beneficiary spouse. And it's a happy medium for some people because they don't want to part with their assets, but they want to use their exemption. So they create a SLAT, at least their spouse has access to the assets and they can indirectly access those assets through their spouse. Just two things to keep in mind: when the spouse passes away, the beneficiary spouse, the donor spouse no longer has access to those assets. And you need to be aware of the reciprocal trust doctrine. So if two spouses create identical or almost identical trust for each other, the IRS could collapse the whole thing and say you've created a trust for yourself, for each of you, like your own self. So it's going to be part of your estate. So the terms need to be slightly different. If you have a good attorney, they'll know what to do and hopefully make it so that we're not going to fall into that reciprocal trust doctrine. GST exemption, you still have a GST exemption of 11.7 million. Same as the lifetime exemption, it's going to decrease to 5 million. So please, make sure that you're considering that when doing your gifting as well. Okay, next slide, please. Okay, charitable gifts. So for gift tax, you get dollar for dollar deduction for gifts to charities. So if you're charitably inclined, go ahead and make those charitable gifts. The income tax deduction, the deductibility will depend on the type of gifted property. I know Ron touched on that earlier, and I know PJ is going to talk about that later. So wait until then. Split interest trust. Now this is where you give interest in the same property to non-charitable and charitable beneficiaries. CLATs basically have an annuity payment out to charity, and then you have a non-charitable remainder beneficiary, and a CRUT is the flip, where you have a non-charitable beneficiary receiving the annual payments, and then charity is the beneficiary. So that's another option with respect to charitable gifts. Next slide, please. I just wanted to mention state gift and estate tax planning briefly, because we're always so focused on federal. We just need to keep in mind that states have their own estate and gift and inheritance taxes. So I just listed the 12 states and the District of Columbia that have an estate tax. So keep that in mind. And the exemptions are not as high as federal, and they're all different. There are 6 states that have an inheritance tax. Connecticut has a gift tax. So, you need to be aware of that when making gifts. And then I just gave some stats for New York State, since here we are in New York State, at least I am. So if that's important to you, there are just some stats with New York. And New York State is unique in that they have an exemption of 5.9 million. But if your estate is over 6.2 million, you lose that exemption completely. You're taxed dollar for dollar on your estate. We call it the cliff. And yeah, so when we do planning for our New York clients, we if we can, we'll try to get their estates under that 5.9 million, or at least under 6.2, so they get some benefit from the exemption. Next slide, please. Foreign individuals. Want to mention this briefly. If you are a foreign individual, not a US citizen, or you have a client that's not a US citizen, just please keep in mind that these state gift tax rules are different. And please reach out to our international tax practice or the trust and estate practice so we can help you figure out what exactly needs to be reported and what exemptions you're entitled. Okay. Next slide, please. Okay, we have our third polling question. What is the current lifetime exemption amount? Remember, this is the lifetime exemption amount. $15,000, $11.7 million, $11.58 million, or $5.93 million.
Mary, when people are just answering that, one additional question. So I front load my 529 plan.
Yes.
$2,000 in. What years do I have to file a gift tax return for that?
Oh, so you only have to file, you have to file in the first year to make the election. And then in subsequent years, you only have to file if you've made other gifts. If you make no other gifts in the subsequent 4 years, then you do not need to file just to report that 529 gift.
And I know we said before, people were scrambling, back in September. Would you advise clients to do any additional gifting now? If they still have that exemption available, or?
Yeah, I mean, I do have clients that are doing it at least to use your annual exclusion, because I mean, it's going to start over again in January. So why not make a $15,000 gift now and $16,000 gift in January if you want? I don't think people should wait, because I don't know where this legislation is going to end up and what could be on the horizon.
No, I agree with the 15,000, but if I only used $2 million of my exemption, would you advise clients to make some big gifts now to try to get up to that $11 million?
Yes, I do. And that's only if they feel comfortable doing it. I know the exemption is high and some clients are just not comfortable giving away that amount of money, which is fine. But if they're comfortable and they can afford to give that money away, then yes, absolutely.
All right, perfect. Thank you. And what was the answer to your polling question?
Oh, the answer was B, 11.7 million. Very good. Excellent job.
All right.
Okay, now I'm going to pass it up to PJ. Sorry, I hope I left you enough time for your
Thanks,
piece.
Mary. Thanks, Mary. Well, the moment we have all been waiting for is finally here. We can all agree a lot has happened in the last 2 years. A lot of new acts were enacted. Ron touched upon these, but just a quick recap. First came the CARES Act of 2020, which was enacted into law, aimed at providing relief for individuals and taxpayers that were impacted by the coronavirus outbreak. There were many key provisions included as part of the CARES Act. Some of them were direct payments of $1,200 for single filers, $2,400 for married couples, plus an additional $500 per child. Unemployment benefits were provided. Employers were able to delay a portion of the payroll taxes, use of retirement funds, waiving the 10% withdrawal penalty, increase in the 401k loan amounts, and the most important of all, the required minimum distributions from IRA and 401k plans were suspended. Next came along the pandemic emergency unemployment compensation. It's a lot of acronyms in 2020 and 2021. The pandemic emergency unemployment compensation, also known as the PEUC, was established by the CARES Act as an emergency program designed to help people who had exhausted their unemployment benefits. This act additionally added additional weeks of benefits. Then came along the American Rescue Plan Act of 2021, which provided additional relief for individuals and businesses, such as recovery rebate credits, increase in child tax credit, extension of several tax measures which were introduced during 2020. Next slide, please. Well, it's definitely worth talking about a lot of planning opportunities, recovery rebate credit. In addition to the first 2 rounds of the stimulus payments, which were provided by the CARES Act in 2020, the Consolidated Appropriations Act, also known as the CAA, distributed an additional $600 recovery credit to eligible individuals during 2021. Eligible taxpayers who did not receive these payments will be able to claim them as a child tax credit on their 2021 tax returns, which will be filed next year in 2022. Now, keep in mind, for 2021, the American Rescue Plan Act increases the child tax credit to $3,000 per qualifying child age 6 or older, and $3,600 per qualifying child under 6, which is actually up from $2,000 in 2020. This credit will be fully refundable, increased from a $1,400 credit during 2020. The most important thing to note here is the maximum age for a qualifying child now is 17, previously 16. Next slide, please. Well, we all know what capital gains is, right? Income from a sale of an investment held for more than 1 year is generally taxed at preferential capital gain rates. For 2021, the long-term capital gain qualified dividend rate remains unchanged, which is 0, 15, and 20%, depending on the ordinary income tax bracket. Some of the key planning opportunities in this area: you can consider holding your capital assets for at least 12 months, as short-term capital gains rates are taxed at ordinary income tax rates, which are generally higher. Consider gifting appreciated securities or mutual fund shares to your children or grandchildren, as Mary indicated during the estate and gift planning. And this future generation could generally be in a lower income tax bracket. Now, depending on the income, they may pay less or no tax at all on these long-term capital gains when these shares are sold. You can also consider selling unrealized loss positions in your investment portfolio to offset capital gains recognized early in the year, also known as the loss harvesting rules. The Act, another acronym here, which came the Tax Cuts and Jobs Act of 2017, also known as TCJA, created Qualified Opportunity Zones program to offer sizable tax breaks to investors making qualified long-term investments that have potential to promote economic growth in zones designated for economic development. Some of the tax benefits included here: tax deferral, tax reduction, and elimination. Next slide, please.
PJ, I just want to say something. One of my partners I speak to a lot has a client that's selling a lot of their securities, recognizing gains in 2021 to get around the surcharge that's going to happen, the proposed surcharge that's going to happen in 2022. Now, I've spoken to a lot of money managers that are not using that, that are not going down that path, but I've heard a number of other money managers from partners are going down that path. So it's just something that people should speak to their clients about, and their money managers, to see how they feel.
That's a great point, Pat. Net investment income tax. We all know what a net investment income tax is. It's an additional tax on top of your regular income tax. Individual taxpayers with modified adjusted gross income of more than $200,000 per year, or $250,000 for a married filing joint couple, may be subject to this net investment income tax. It's a little factor formula. The net investment income tax equals 3.8% of the lesser of the net investment income, which we'll talk in a second, or the amount by which your modified adjusted gross income exceeds the applicable threshold. What is net investment income? It includes anything: your interest, dividends, capital gains, rental income. The key exception here is unless derived from an ordinary business activity, that is not subject to the net investment income tax. What are some planning opportunities in this area? You can consider electing installment sale treatment so that gains are spread over a number of years. By spreading the income over multiple years, your current net investment income and modified adjusted gross income may be reduced to minimize or potentially eliminate the 3.8% tax for the current and future tax years. As discussed earlier, consider selling unrealized loss positions in your investment portfolio to offset capital gains recognized earlier in the year. One of the other key considerations could be tax-exempt income, which is another way, because it's not subject to the 3.8% tax. You can consider switching investments to tax-exempt investments if it makes sense for your portfolio. Just bear in mind the state income tax issue of these such investments must be considered. Next slide, please. Retirement plans. Contributions to a traditional employer-sponsored plan are typically pre-tax, therefore reducing your taxable income. You can maximize before year-end your 401k plan contributions to boost retirement savings and reduce your current year taxes. The maximum contribution to a 401k plan remains at $19,500 in 2021, which is actually unchanged from 2020. Employees aged 50 or older can make an additional catch-up contribution of up to $6,500, also remains unchanged from 2020. For our self-employed folks, consider setting up a SEP IRA plan, self-employed retirement plan, in order to maximize the allowable contribution each year. For the folks who took out coronavirus withdrawals last year, keep in mind, you can actually pay that back, recontribute back into a qualified retirement plan anytime during the following 3-year period to eliminate otherwise reportable taxable income. Another key consideration could be given to a Roth IRA conversion. A Roth IRA conversion lets you convert a traditional IRA into a Roth IRA. You will immediately owe taxes right now at the converted amount, but qualified withdrawals in retirement will then be tax-free. A conversion can actually make sense if you expect to be in a higher tax bracket in the future. Just bear in mind, due to the tax laws which were passed in 2017, a conversion can no longer be reversed back to a traditional IRA. So just a key consideration. The required minimum distributions are back. What does that mean? Well, RMDs was suspended for 2020 without a penalty under the CARES Act, but this was allowed only for a single year. A taxpayer who's now 72 years old by the end of tax year 2021 is required to take an RMD for 2021. Failure to not to take so will cause a penalty of 50% on the amount not distributed. Next slide, please. Standard versus itemized deduction. The standard deduction amounts have increased for 2021 and is actually claimed by the vast majority of the American taxpayers to reduce their taxable income. If your standard deduction is lower than your itemized deduction, then you're better off claiming those from a tax savings perspective. Some of the itemized deductions here include medical expenses. For 2021, the unreimbursed medical expenses can be deducted to the extent that your expenses exceed 7.5% of your adjusted gross income, which remains unchanged from 2020. Some of the eligible medical expenses include your healthcare insurance premiums, your long-term care insurance premiums, medical and dental and prescription drugs. The CARES Act also added over-the-counter medications as qualified medical expenses. Since individuals generally use the cash basis of accounting, medical expenses must be paid in the year in order to be deductible. Bear in mind, if you're paying through a credit card payments are deductible in the year charged rather than paid. The next itemized deduction worth talking about is the mortgage interest. For tax years 2018 through 2025, the Tax Cuts and Jobs Act reduced the limit on interest deductions pertaining to outstanding mortgage debt incurred after December 15, 2017 from $1 million to $750,000. The interest on debt incurred prior to December 15 of 2017, but refinanced later is deductible to the extent that the new debt does not exceed the original debt. What's a key planning opportunity here? Well, keep track of how and when your loan proceeds are spent. For example, portions of your mortgage debt utilized to acquire business assets are deductible as trade or business interest or as an investment interest expense. Some of my clients will call me and they'll be like, PJ, does it make sense to pay off my mortgage? Well, if you're thinking about paying off your mortgage before retiring, it is important to compare the pros and cons here. One of the pros of paying your mortgage is that a guaranteed risk-free return. One of the cons of paying off your mortgage is reduced liquidity, as it's actually much easier to access funds sitting in investment or bank account.
And one thing I want to say that what PJ I just want to reinforce it. There's a lot of planning opportunities with the mortgage. For instance, if you had a traditional mortgage of $5 million, so effectively you're only deducting 20% of the interest. So if I'm paying $100,000 of interest a year, I'm deducting only $20,000, and you're losing that other $80,000. There's planning opportunities to possibly get you the full deduction of that $100,000. So please reach out to your Citron Coupman team to determine how you could possibly achieve that additional deductions. Sorry, PJ.
No worries. For all my philanthropic individuals, talking about charitable donations is very, very important. The incentives of charitable giving enacted by the CARES Act has been extended through the end of 2021, as Ron and Mary mentioned. What does that really mean? Well, individual taxpayers are allowed a deduction of cash contributions, note the keyword here, public charities, up to 100% of their adjusted gross income. Bear in mind, the cash donations to a donor advice fund and private foundations are not eligible for this 100% limitation. Secondly, gifts of appreciated security or gifts of use by public charities are deductible up to 30% of adjusted gross income. Taxpayers who do not itemize, in other words, use standard deduction, can claim up to $600 of cash contributions for a married filing joint couple. What are some of the key planning opportunities in the charitable world? Consider bunching your donations in 2021 to take advantage of the most generous tax reduction limits. You can donate your appreciated securities to avoid paying capital gains tax and receive a fair market value reduction for stock held more than 1 year. If you revisit your portfolio and if your stock has depreciated in value, you might want to consider selling that and donating the cash proceeds to a public charity. There's a double benefit here. You will receive a charitable deduction as well as a capital loss benefit on the sale of stock. As mentioned earlier, capital losses offset capital gains, and the maximum net capital loss in any tax year is $3,000 for a married filing joint couple. Any unused capital losses are then rolled over to future years. Next slide, please. I know we're very coming close to the hour, but one of the most generous provisions in the tax code here is the qualified charitable distribution, QCD. Taxpayers who have reached age 70 and a half can donate up to $100,000 of their taxable IRA distributions directly to a qualified charity. This donation satisfies the required minimum distribution requirement and is also excluded from your taxable income. A charitable deduction cannot be claimed for this because this is not included as part of your taxable income. But one of the key considerations and worth noting again here is that the required minimum distributions for IRA accounts have been resumed for 2021 and must be made before December 31st. Next slide, please. Some other key considerations, final thoughts here for small businesses. Claim the employee retention credit. If your business has employees, you can claim up to $7,000 per year, per employee per quarter to offset the payroll tax liabilities. The general rule of thumb, defer income. If a business uses the cash method of accounting, billing and collections of services can be deferred until year end. Accrual method taxpayers can delay shipping products or delivering services. But just do me a favor, don't upset your clients because I don't want them to leave bad reviews for you on Amazon and Google. Accelerate your expenses. Cash basis taxpayers can consider accelerating the expenses before paying before year end. There's a home office deduction eligible for taxpayers who are primarily using for business activities, acquisition of assets, and many other. With that, next slide, please. With that being said, last and polling question. In 2021, individual taxpayers are allowed a deduction for cash contributions to public charities up to A, 20% of adjusted gross income, B, 30% of adjusted gross income, C, 60% of adjusted gross income, or D, 100% of adjusted gross income. The correct answer is 100% of adjusted gross income. It's for public charities.
Thank you, PJ. Nice job. So this concludes our webinar for today. I just want to thank Mary, Ron, and PJ again. And I just want to leave you with this. The year end is coming. We have 23 days left. Reach out to your Citron Koopman tax advisor today, because once the year closes, there's no planning opportunities that can be. There's generally not a lot of planning opportunities that can be done after year end. So reach out to your advisor today, run a tax projection, see where you stand, and see what other planning opportunities can be implemented for 2021 to possibly save you money. So again, thank PJ, Mary, and Ron, and everyone. If we don't hear from you, have a healthy and happy holiday season. Thank you again.